Welcome to the Deep Dive. We sift through all that information you share, find the signal in the noise, and give you the knowledge you need. Today, we're tackling a really fascinating one. BigBear.ai Holdings, Inc. Ticker BBAI. This company is, well, it's right at this intense crossroads. On one side, you've got huge tech promise building AI for the military, really cutting edge stuff. But on the other, significant ongoing financial struggles. It's quite the mix.
That really is the core of it, isn't it? And for this deep dive, we've anchored our analysis to its closing price on October 24, 2025, which was $7.05 a share. So the big question we're trying to answer for you is this. Can this small AI contractor currently losing money actually pull off a massive pivot? Can it become the next big defense tech player? Or are these financial problems just too deep? Will they keep it grounded?
Yeah, what immediately jumped out from the sources was just how stark that conflict is. You see this genuinely advanced AI, the kind the Department of Defense really needs. And that's paired with, honestly, a rock-solid cash reserve. That looks good.
Yeah.
But then you see this history of just not making money and revenue growth that's barely moved. It's definitely a high-risk, high-reward situation. The story seems way ahead of the actual numbers right now.
Exactly. And maybe the best place to start is unpacking that conflict within the business model itself.
Okay, let's do that. Let's unpack this dual-sided engine BBAI is running. Their goal, they say, is decision dominance for their clients. Basically, they want their AI to help people in high-stakes situations make better, faster decisions. And they do this through two main parts. Cyber and engineering, that's more like specialized cloud and IT work, and then analytics, which is where their predictive AI tech lives. Historically, pretty much all the money's come from the U.S. government, right? Mostly defense and intelligence contracts.
Yeah, and it's really crucial for you, the listener, to get how that defense money comes in, because it really shapes their financial picture. Most of it comes from what are called time and materials contracts. Over the last year, we have data for that was about $88.74 million. Now, T&M, it basically means they're selling skilled labor by the hour. And the result to cash flow gross margins that are, frankly, disappointingly low, usually hovering around 25 to 28%.
Right. And if you're aiming for that huge valuation, that explosive growth potential, you don't want to look like an IT services firm with those margins. You want to look like a software as a service company, a SaaS business, pulling in margins of like 70 or 80%.
Scalable.
Precisely. Now, that T&M revenue, it does provide some stability, gives them a bit of visibility, like that $300 million backlog they reported in Q2 2025. That stability is, let's say, one end of their strategic barbell. Okay, but then there's the other end, the risky end of the barbell, where the whole growth story really comes alive. And that's this big, high-stakes move into commercial markets. And it wasn't gradual, was it? It was kicked into high gear by acquiring Pangiam back in 2024.
Oh, yeah. That Pangiam deal was absolutely critical. It gave them ready-made biometric and vision AI tech. And we're already seeing that play out. High-profile uses like their Veriscan platform. It's being rolled out at major airports, Chicago, O'Hare, Nashville. This isn't just some lab experiment. This AI is actually being used by Customs and Border Protection for passenger ID right now.
So that commercial push, using the Pangiam tech, that's their answer to the low-margin government work problem. They're trying to leverage that deep government expertise, knowing how to make AI work in really serious, high-stakes situations, and package it up as software products. And their product list, things like ProModel, Shipyard AI for digital twins, and the Orion platform for DoD planning. It shows they do have the technical skills, they have the chops.
It paints a very, very compelling picture of future success. Absolutely. But like you said earlier, we have to ground this story in the cold, hard numbers of today. Because if the story is compelling, the financial reality is, well, it's jarring. Which brings us nicely to segment 2, the financial reality.
Great. Let's start with that gap we mentioned right at the top. The company's valued by the market at roughly $3.11 billion. But the actual revenue they brought in over the last 12 months, the TTM revenue, is only about $153 million. That multiple, the price-to-sales ratio, it's huge. It tells you the market is betting on extreme, almost immediate exponential growth.
And that expectation just clashes really violently with their actual track record. The sources show their top-line growth has been almost flat, averaging just 0.7% a year over the last few years. That's barely moving. And making things worse, management actually had to cut their revenue forecast for 2025 quite significantly. They pointed to lower volumes on some key U.S. Army programs. So when that core, supposedly stable business starts shrinking, well, the pressure on that commercial pivot just goes through the roof.
But the real weakness financially isn't just the slow growth, is it? It's the lack of profit. And the numbers here are kind of staggering. Their trailing 12-month net margin is massively negative. It sits at negative 269.28%.
Yeah, let's pause on that minus 269% margin for a second, just so you, the listener, can really grasp it. The sources basically suggest that for every single dollar BBAI earns in revenue right now, they're losing almost $2.70. And that loss shows up in another really important metric, too. Return on invested capital, or ROIC, that's also deeply negative, at negative 108.76%.
Okay, wait, let's stop there. ROIC. That sounds important, but what does that actually mean in plain English? What's it telling us?
It's really a measure of efficiency. How well is management using the capital it has? When ROIC is that negative, it confirms the business isn't just failing to make a profit, it's actively destroying economic value with every dollar of capital it puts to work. Financially speaking, that's pretty much the definition of a business in crisis mode.
How does a company lose that much money and still have a multi-billion-dollar valuation? I mean, what keeps the lights on?
That's where the balance sheet becomes the story. Yes, the company is absolutely burning through cash, consistently. They've had negative cash flow from operations for 5 years running. TTM free cash flow was negative $37.74 million.
Right.
But they have a really significant cushion. They're sitting on $390.8 million in cash and equivalents. And very little debt, a debt-to-equity ratio of just 0.39.
Okay, so that cash pile, that's the lifeline, that's the runway. Burning roughly $38 million a year against nearly $400 million in the bank. Sounds like they have time, but how quickly do they need to deploy that cash? You know, for things like the Pan-Gym deal, for this commercial push, before the market starts getting really nervous and maybe demands they raise more money.
It is absolutely a race against time, and it really highlights their whole capital allocation strategy. Management is funding everything, the growth, the acquisitions, the commercial expansion, using money raised from shareholders, not from profits generated by the business. They are, in essence, burning through the seed corn, hoping to plant this massive commercial farm before the corn runs out.
And this fundamental conflict, the huge divide between the current financial reality and what the market expects, that leads us straight into segment 3, market sentiment and valuation. This explains why BBAI is such a classic battleground stock.
Right, because those financials are so negative, traditional valuation methods, the ones based on current earnings or cash flows, they're basically useless here. So we have to rely on looking forward, on models. Our educational discounted cash flow model, the DCF. Well, we had to plug in some really aggressive growth assumptions. Even being super optimistic, think 35% growth every year for 5 years and eventually hitting a 15% free cash flow margin, which would be a huge success even then, we can only get to an estimated intrinsic value range of about $2.50 to $4.50 per share.
Okay, that is a massive disconnect and a really important one for people to hear. The stock is trading at $7.05. If even a wildly optimistic model struggles to justify $4.50, what else is the market pricing in to get to $7.05? Is it just pure speculation?
It seems the market is pricing in a future scenario that's even more aggressive than that 35% compound growth rate we used. It's pricing in absolute perfection. It's assuming this rapid, flawless transformation from a low-margin government services firm into a super scalable, high-margin AI platform for both defense and commercial sectors.
And you can see this disconnect even when you look at Wall Street analysts, right? The professionals covering the stock. Most of them actually have a buy rating. About 80% believe in the story, it seems. But their average price target is much lower than where the stock is trading, somewhere around $4.85 to $5.83, depending on the source. So they seem to like the long-term idea, but they think the market's gotten way ahead of itself right now.
Exactly. And this detachment from the fundamental numbers, it gets amplified by the market structure itself. We see huge bearish sentiment reflected in the short interest. It's extremely high, 18.38% of the public float. That's nearly 80 million shares being bet against the company. These are sophisticated investors making very large bets that the price is going to fall, arguing that the current valuation just can't be sustained by the actual cash flows or lack thereof.
And that huge short interest, that's the other side of the coin, isn't it? It contributes to the volatility. While it shows a lot of people are betting against it, that sheer volume of short positions also creates the potential for a massive short squeeze, you know, where any bit of good news or even just a market rally forces those short sellers to buy back shares quickly, which can make the price spike dramatically, regardless of fundamentals.
And we also have to look at who owns the stock, because the changes there tell a fascinating story about belief, maybe lack of belief. Just recently, AE Industrial Partners, they were an early, knowledgeable investor. They sold off their entire position, liquidated everything. That's usually a pretty strong signal when an insider or early backer cashes out completely.
But on the flip side, you see these huge passive index funds, Vanguard, BlackRock, significantly increasing their stakes. What's going on there? Is that a vote of confidence?
Not necessarily confidence in the company, but more a reflection of how passive investing works. When Vanguard buys millions of shares, it's likely not because some analyst there loves BBAI's turnaround story. It's probably because BBAI got added to major indexes, like the Russell 2000. So the index fund has to buy the stock to track the index. This passive buying creates artificial demand, pushing the price up, kind of detached from the company's actual performance. Meanwhile, you look at the insiders, the executives, the directors, the people who know the business best from the inside. They showed heavy net selling over the past year. Over 141 million shares sold by insiders.
Wow, that's a really stark contrast. Passive funds buying because of index rules, while insiders and early investors are heading for the exits. It really paints a picture of just how speculative the stock feels right now.
Okay, let's broaden the view in segment 4. Let's look at the SWOT analysis. Strengths, weaknesses, opportunities, threats, and those external factors. So internally, the strengths are pretty clear, right? They have deep, genuine expertise in the defense and national security world. That's hard to replicate. They've got that crucial $390.8 million cash cushion, and their leadership is incredibly well connected. I mean, CEO Kevin McLennan, former acting head of Homeland Security, former CBP commissioner, that kind of access in Washington is, well, it's invaluable in their line of work.
Absolutely. But the internal weaknesses are just as significant and just as clear. That chronic unprofitability we keep talking about, the history of stagnant revenue,
Okay.
and this inherent reliance on government contracts, which can be volatile, lumpy. If a big program gets delayed or cut, BBAI feels it immediately and significantly. And then looking outside the company, the competition. It's fierce out there. They're not just competing with small startups. They're up against giants like Palantir Technologies, which is vastly larger and already profitable. And other aggressive players like C3.ai are also fighting for those same defense and commercial AI dollars. It's a tough neighborhood for a smaller, unprofitable player.
And we absolutely have to factor in the broader macroeconomic threats, too. This whole environment of higher for longer interest rates. That's actively harmful for companies like BBAI, whose valuation leans so heavily on future growth promises. Why? Because higher rates mean you discount those future hoped-for cash flows more heavily. It directly lowers their present value today. So the longer BBAI stays unprofitable, the more damage rising interest rates can do to its theoretical value and likely its stock price.
And one more threat, kind of geopolitical, but very relevant for a tech company. Those proposed U.S. tariffs in 2025 on semiconductors and electronics. This isn't just abstract economic policy. This could tangibly increase the cost of building and running the AI infrastructure they depend on. And if costs go up significantly, their customers, even the DoD, might have to scale back projects or delay them. That could be a major headwind for the whole industry, hitting BBAI hard.
So when you put it all together, the core conclusion we have to draw from the sources is, well, it's pretty stark. Investing in BBAI at its current price of $7.05, it's not really a bet on their proven financial track record because that track record isn't good. It's a highly speculative wager. You're betting that this difficult, dramatic, strategic turnaround will actually succeed despite some powerful financial headwinds, intense competition, and a tricky macro environment.
So wrapping this up, what does this all mean for you, the learner? You're looking at a company that genuinely has the potential to be a force in defense AI. It has the tech, the expertise, the connections. But right now, it's priced for absolute perfection. It seems fueled more by a compelling story and maybe some passive index buying, while it's still burning through cash instead of generating it.
And that brings us to a final, maybe provocative thought for you to chew on as you process all this. Think about BBAI's core, established value, that deep trust and expertise within the government, particularly defense and intelligence, that's real. But the current valuation seems heavily dependent on them succeeding wildly in the commercial sector, things like optimizing supply chains or improving manufacturing logistics. So ask yourself this. Is the expertise needed to optimize the commercial supply chain really as rare, as defensible, or ultimately as valuable as the expertise needed to secure national borders or help command military forces? The market, at $7.05, seems to be betting that yes, those two types of expertise are equally valuable commercially. Whether that assumption holds true, well, that might be the difference between BBAI being a $7 stock or perhaps closer to a $3 stock down the road. Something to definitely ponder.